Next up, we're talking about tax savvy strategies with a principal of Clifton Larson Allen. Again, one of the top five accounting firms in the country, 23,000 real estate tax clients. These guys know what the heck they're doing. And I'm not just saying that because I've personally used them. So, welcome to the stage for the first time, Mr. Ed Carey, principal at Clifton Larson Allen.
Thanks again, Ben, for the introduction. Makes me sound far more qualified than I probably am. So I'm keenly aware it's 3:30, it's day 2 of the conference, and we had an open bar last night, and I'm here to talk to you guys about taxes. So bear with me, but luckily I wasn't the first presentation today after said open bar yesterday. Quick disclaimer, don't hold anything I say against me in the court of law. I reserve the right to be consciously or unconsciously ignorant based on the presentation yesterday. Quick overview of what we're going to talk about. I'm going to hit on current tax laws affecting real estate. Some of this I assume many in the room are well aware of, but maybe not others. Just things to make sure is on your radar as real estate professionals, investors in this room. Common mistakes I see in our tax base, or our client base at CLA within the real estate industry. Then a few high-level strategies to maximize potential tax benefits, again, under current tax law. We're in a unique period of time. I don't know if anyone follows the news at all. We have an expiring Tax and Cuts and Jobs Act and a pending potential extension of that or new tax legislation. So at the end, I have a couple of slides where we're going to talk about tax law in the future, 2025 and beyond. When Ben first asked me to present, this was before the election. I figured by March, we'd either have a Biden term number 2, or I guess it would have been a Kamala term number 2 at that time, or we'd be somewhere within the first 100 days of Trump's administration, so we'd have some clarity. I'm here to tell you we don't. So those 3 bullet points are exactly what this is. What I think, maybe we'll see what's going to happen in 2025 and beyond. So kind of just the things that have been discussed on the Hill within this current administration that may or may not be implemented. So hopefully you could take that information. I'll give you kind of where me as a principal at CLA or kind of our firm's position is on some of these things as they stand now. Obviously nothing yet set in stone. So Ben kind of hit on this, just shameless plug about CLA for those of you who haven't heard of us. We have 9,000 CLA family members, 130 offices across the United States. Then we also have a global component, primarily in Western Europe, our largest affiliation and international office actually in London. Again, skipping through some of these. Ben hit on this. So we have 50 offices within CLA that have $1 million of real estate work, over 23,000 tax, audit, and consulting real estate clients, and 500 CLA family members and coworkers who work within the real estate industry. Okay, so current tax laws affecting real estate. This first one, and I've linked these all to the code, so if you leave here, you can sound like you know what you're talking about, or you can bring these up to your existing tax providers. Section 1031. So this one, I'm sure many in this room have heard of before. This allows for like-kind exchanges, tax-free within real estate. There was some talk pre this administration that potentially in 2025 this could go away. As it currently stands, nothing in that realm is on the table. So still a strong tool for a real estate investor to use to roll over gain from a sale of an asset into another like-kind property tax-free. Section 721, so this permits the deferral of gain or loss when property is contributed into a partnership and then eventually upreit. Benefits from using this is obviously the deferral of that capital gain. It creates liquidity, but obviously you lose control over your property when you do so. Section 469, I'm sure many in this room are familiar, the old adage of passive losses can only be offset against passive income. I do want to note, while that is a general rule, there are 2 exceptions. Closely held C-corps can offset in certain circumstances passive losses against active income, not investment income. And then if you make certain investments and elections in affordable housing, usually ground up development, those losses, if they're considered passive in nature, can be used to offset active income. Other current codes that impact our real estate clients a lot here at CLA, Section 163J. So this limits the amount of interest you can deduct. It's a complicated calculation, but what a lot of our clients tend to run not afoul of is highly leveraged real estate portfolios, a ton of interest expense, not subject to the ability to deduct it. So what you could end up doing from a cash flow perspective is you paid a creditor, a lender, a third party, the actual interest payments and not have that benefit of a deduction, and you have to carry that forward to future periods. There are certain situations where you can elect out of that. Now, the caveat, the tax man giveth and the tax man taketh away. Under some of those circumstances, you then have to elect out of certain depreciation methods. So you may have the benefit, and this is where kind of structuring and tax planning comes into play, you may have the benefit to deduct more of your interest expense, but you're losing potentially depreciation and other types of deductions on the other hand. This is simple. This covers the rules for depreciation under the current IRS code. If you leave here with anything, just because so many tax returns cross my desk where the wrong useful lives are used for residential and commercial property, 27.5 for residential, 39 years for commercial. FERPTA. So this is big for anyone who wants to raise funds from a foreign investor. They will be subject on the sale of U.S. real estate to our tax laws. Now again, it doesn't necessarily impact you as the syndicator, but it does impact you in the way you're able to raise capital. And then on that transaction, you're actually required to withhold 15% of the realized gain to make sure that individual, that foreign individual, gets subject to our U.S. Tax law. As recently as 22, back to FERPTA, the Foreign Investment Real Property Tax Act, there was talk about revamping FERPTA. I think it was like late 22, early 2023, to hopefully spur, spur investment in real estate projects in the U.S. from international sources. There hasn't been anything on that with the current administration, or really nothing since late 2022, and I would suspect it's probably going to remain in place as is for at least the foreseeable future. All right, common mistakes or pitfalls. I didn't really know how to title this. I didn't want to call anybody out in case someone in this room maybe did this. But these are kind of the four main categories we see in terms of the real estate industry when we get a new tax client or even an existing tax client maybe comes to us too late and doesn't bring us in on the consultation on the front end. Confusing capital expenditures with repairs and maintenance. So really consider the unit of property. And this one, because painting the outside of a multifamily or the rooms within a hotel or within a multifamily project, those are repairs. So this is kind of something existing, something in service. And when I say consider the unit of property, take this hotel, for instance. It's 25 stories. So let's say the owner of this hotel decided they want to renovate 7 rooms a year, 5 rooms a year, 5 floors a year for the next 5 years. Those, because the unit of property is the building, would be or could be considered repairs and be ordinary deductions in the period paid. The other mistake I see a lot is whenever you're replacing something, something should come off, right? Makes sense intuitively, but too often we just see that basis of the building grow and grow and grow, and you're not taking advantage of the disposal of those assets that are no longer in service. Okay, proper structure of investments. The first one, just before an entity is created or a deal closes, a sister company or maybe even personal expenses are being paid on behalf of that entity, and they never truly get captured in the correct corresponding real estate entity. See it a lot with pursuit costs, capturing what was truly incurred for acquiring that next deal. Incorrect entity selection, again, just knowing that there are certain requirements, compliance requirements with a REIT. Nothing wrong with a C Corp. You just could be subject to double taxation. And then please don't set up any company as a sole proprietorship, please. You laugh, but one from the legal perspective, and then also from a tax situation, not the best. I kind of hit on 163J, so the next one, and we're seeing more of this, so debt cancellation and debt relief obligations. So what gets missed a lot, I guess I'll give you an example. So say you borrowed $10 million to build a multifamily asset or a collection of multifamily assets. Now today, that fair value of the assets, only $5 million. And like kind of what we've talked about today, a lot of lenders are working with the owner-operators, modifications, things like that. But let's say that lender decides to forgive $2.5 million of that debt. Well, if you don't make the adequate election on your tax return, that $2.5 million forgiveness, and let's not even get into the realm of bankruptcy or insolvency, could be considered taxable income in the period forgiven. And that's a bad situation, right? Because you have taxable income that you have to pay taxes on potentially, and no liquidity to pay that taxes. It's an election you can make, and then that forgiveness can reduce the basis of your asset. So again, like I said, taxman always kind of gets paid, is that'll reduce your basis in your asset going forward, and then potentially on sale would be when you would pick up that taxable income. Two presenters ago, he hit on this. It was warm to my heart about structuring of PPM and operating agreements. Just a quick note on this. Something you really want to do, and I noticed the typo. I assure you I'm better with numbers than the English language. Is when you're setting up joint venture agreements or multi-tiered partnerships, really think through how you want your allocations to function. We like to come in on the front end, have it verbally described to us what you want. We're not lawyers, so we won't draft these agreements, but we can mark them up and give notes. Come in on the front end, so hopefully what you operationally want to happen legally is in those agreements, because you don't want to come to the end, right, and there's some type of dispute with how something got allocated amongst LPs, partners, JVs, things like that. Second bullet point there, look, there's nothing wrong with related party debt and partner loans. They're a great tool for liquidity or short-term funding. However, if you don't have if you have above or below market rates on your related party debt or no interest, potentially the IRS could classify those as distributions or income. And again, you don't want to be in that situation. This last piece, so improper purchase allocation, and this really needs to be done on the front end. And I have another slide where we're going more detail. But that first bullet point, so if you buy an office building, right, everyone gets very fixated on allocation between land, the building components, things like that. But 49 of the 50 states have either lower or no taxes on intangible assets. And if you buy an office building, potentially, if you do your allocation systematically and hire an expert or have support for it, you could have things like market rate rent leases in place that you allocate a portion of the building to, right? One, reduction in useful lives from an amortization or depreciation perspective. And then two, you're not subject to the same taxation in that local state. Could reduce your property taxes and your tangible tax returns. And then the last piece, so recapture of depreciable assets can be taxed at the highest capital gain rate, while land isn't. So we see a lot of times this fixation on purchase price allocation, getting as much as you can into building. Fine, but if you're only going to hold an asset for a short period of time, what's the point of accelerating depreciation if it's just going to be subject to recapture in 18 months? Again, there's no right or wrong answer for a lot of these, but it's just trying to figure out the best solution from a tax strategy perspective for you, your investors, and your real estate project. These, just knowing that earnest money deposits or option payments from buyers could be taxable in the period received. The second one, anyone who does 1031 exchanges, funds received from an early disbursement could be subject to taxes, even if the whole entire transaction can be deferred for gain. And then this last one, there's always such a not always, but I've seen situations where you want to dissolve the entity, you want to wind it down, right? And what gets mixed is either entity level tax, SALT, or those trailing costs, and you've dissolved your LLC, right? You've just, all the cash is gone, and all of a sudden you have some type of final tax return. And the last thing you want to do is paying that out of pocket as the GP, or going back to your investors and saying, hey, by the way, we have this tax burden I didn't consider, I didn't accrue for. From a SALT planning perspective, just know that every state has different and local regulations. Are you communicating with your LPs in a multi-state real estate fund, the potential, and how you can best protect them from a multi-state filing? The second bullet point, I've seen often, especially in our fund administrative practice, where it's not considered in the modeling or the underwriting of a rehab project, that in certain jurisdictions, those construction materials, those services are subject to different SALT state or sales and use taxes. And then that last one, don't leave low-hanging fruit out there. There's a lot of local and state tax credits and incentives your potential project or deal could qualify for without even doing anything or changing anything. Yep. Withholding taxes? California. New York, I believe, also does. Most states in the Sun Belt don't. I get. Oh, sorry. So the question was, are there examples of states that require withholding taxes on income distributed to non-residents of that state? I can share these slides, and then I have another shameless plug at the end, where you'll see. But if anyone has any questions, I'll be around until tomorrow afternoon, too. I've hit on a lot of these strategies to maximize your tax benefits. We've talked about 1031s. I'll go to bullet point 3, 45L and 179D. 45L is a $5,000 per door credit if you build an energy efficient product. Has to be residential. 179D can be commercial or residential, and that's based on square footage of the energy efficient structure. Opportunity zones. So pre this election cycle, this was really on the chopping block. What this allows you to do, so say you roll over capital gains and you put in a qualified opportunity fund, you can defer those taxes. If you hold the assets in that fund for 5 years, you get a 10% forgiveness in your capital gains tax burden. If you hold it for 7, another 5%. And then any capital appreciation when you sell that asset, if you've held it for 10 years, is tax-free. Technically hasn't been extended yet. It's been talked about. Look, our current president's a real estate developer, or former real estate developer. I would expect this to be extended. Still uncertain, obviously. Everything is uncertain at this particular point in time. Cost segregation studies, another great tool. Just quick hitter there that the bonus depreciation laws under current tax law are expected to phase out at the end of 2027. And then I wanted to hit on this one more time again, getting that purchase price allocation right for what you're going to hold your asset for. All right, 2025 and beyond. I will reiterate, I don't have a crystal ball, and if I could predict the future, I assure you I would not use it to do tax planning full time. So why I include this slide, because everyone is so focused on the Tax Cut and Jobs Act not being extended, or a new tax policy being passed. But something I think that's getting missed is the Inflation Reduction Act is probably going to be repealed. Now, no matter how you feel about that, people, maybe some in this room, have made decisions based on that act. The repeal will probably remove incentives for energy efficient building practices. There were a ton of tax credits for installing renewable energy systems. What we liked at CLA selfishly, because it was something we were able to help a lot of our clients, there was a marketplace to say you couldn't use that tax credit for whatever reason. There was a marketplace where you could sell those tax credits to other corporations at a discounted price who could use those tax credits. The idea incentivize individuals in this room to still build, develop something that's energy efficient, and if you couldn't take advantage of the credit, find a marketplace for it. Repeal of the 5% safe harbor provision. So within the Inflation Reduction Act, say you had a plan to build something energy efficient, you couldn't get the project underway in the particular tax year by a deadline. If you committed and invested 5% of total estimated project costs by that date, you could still qualify even though the full dollars hadn't been spent. Again, if this gets repealed, I don't know what's going to happen in those situations. And then the last one, I mean, there were federal projects expected to be funded under this act, some which have started, some which haven't. I mean, there's been a lot of pause on government spending in the last couple of weeks. I would assume this would be done prospectively, again, but I don't know what will happen, and just trying to give you guys as much information as I can for those existing projects that may or may not have gotten started. Other things that have been talked about, I'm going to pause on the carried interest for a minute, because I have a specific slide on that. So there's been thrown out there changes to the depreciation rules, specific modifications to property depreciation rules, including potential changes the way property owners calculate report depreciation. Again, these are just things that have been floated under the current administration. Nothing has passed, obviously, but these are just kind of high level, so you guys can kind of know as you go out into the market what's on the table and what could happen in 25, 26, and beyond. One more reminder that unless the Tax Cut and Job Act gets extended, the phase out of bonus depreciation is coming. Other things that have been floated, some of these we'll like in this room, potentially reducing the top capital gain tax rate, elimination of the 3.8% net investment income tax, and then this one, I find this one interesting, an annual inflation adjustment for your cost basis in your assets. And then just a reminder, no matter, obviously federal taxes is the largest burden most of us or all of us in this room pay. But just a reminder, whatever happens at the federal level is going to have ripple down effects at the state and local level. So don't get just completely fixated on federal taxation, because whatever happens, again, in certain states, I know they'll be amending their tax laws as well. All right, so I feel like this has been talked about since I graduated college, and I won't mention the date. Ben just aged me 4 years older than I actually am behind stage. But carried interest is once again in the crosshairs. Back in February, President Trump proposed eliminating the capital gain treatment of carried interest in a meeting with congressional leadership. The Democrats have already introduced bills to eliminate this tax treatment. One of the rare moments we have some bipartisan support. Reiterating, over the last 20 years, this seems to get brought up every single administration. And I know a lot of, specifically in my industry, in my profession, generally say they'll never touch it. It's like Lucy and Charlie Brown with the football. They're going to pull the rug on us again. And nothing's ever happened with carried interest. I just want to remind everyone that's not technically true. Under the first Trump administration, he extended the hold period for carried interest to 3 years. So I even hear it on the news, is no one's ever changed carried interest. Well, as recently as the last time the current guy was in office, carried interest did get changed. All right, here's my last shameless plug. So CLA is having a webinar where you'll be able to submit questions and answers. It'll be an hour long, so again, I went super fast, only had 25 minutes here. If you scan that QR code, you should be able to be taken directly to register. If not, come see me, I'll get you the link. I see a couple of you guys still trying. And obviously, it's still only going to be an hour. I promise you, I'm not speaking on this one specifically, but you'll be in great hands. Our plan is anyone who asks a question, we intend to follow up through email if we can't get to it during the webinar. And just lastly, this is my first best effort conference I've attended. I'm having a blast. I hope everyone else here is too. I appreciate the time with you guys here today. That's my contact information. Again, I'll be around the rest of today until about midday tomorrow. Come see me if you want to talk any further. Thank you again. I'm the one, yeah.